an ultimate guide to the cryptocurrency market and investing. Picture this. You are sitting on your couch after a long day's work, and you suddenly start craving the chewy, tangy crispiness of a pizza slice. But you are short of cash. Then, hey, an idea pops into your mind. You suddenly remember the stash of virtual coins you have been mining. The coin you and your buddies believe one day will change the world and the way money works. So why not start now? Luckily, one of your fellow believers agreed to fund your pizza cravings in exchange for some of these digital coins. Believe it or not, the first commercial use of Bitcoin happened in a similar situation, where 10,000 Bitcoins were exchanged for 2 Papa John pizzas. While those 2 pizzas could not have been worth more than $50, today 10,000 Bitcoins are worth over $1 million. What is cryptocurrency? Should you invest in it? How do you go about picking cryptocurrencies to invest in? Today, we answer these questions, taking a deep dive into crypto investments and furnishing you with all you need to know to become a crypto investor today. So sit back, like the video, subscribe for more, and let's get into it. In the past, cryptocurrency was an affair best left to nerds. Then it was described with a lot of jargon and complex words. Today, everyone has a vague idea of cryptocurrency. Even the kid next door will tell you cryptocurrency is a sort of digital money. However, digital media like your photos and songs can be easily duplicated. The same song can be reproduced and played infinitely at almost zero cost, a feature that is particularly crippling for money. You see, money that can be easily counterfeited is no money and has no value. For a currency to have monetary value, it has to be limited and impossible, at least very difficult to counterfeit and double spend. The entire reason for crypto in cryptocurrency is to keep these new virtual currencies difficult to duplicate. Therefore, a complex system of cryptographic tools is employed in creating cryptocurrencies. So you hear of hashing functions, public and private keys, blockchains, etc. But why go through all these troubles to create a new string of virtual currencies when we already have fully functional government-issued currencies? Why cryptocurrencies? The creator of Bitcoin, known only as Satoshi Nakamoto, as well as most proponents of cryptocurrency, believes that the world financial system is too autocratic. They saw a system that revolved around a few powerful institutions and central authorities who drive the financial market according to their whim and for their own benefits, without much regard for the average person. To make matters worse, these elites are backed up by the government. The breaking point for Satoshi and other early crypto developers was the worldwide market crash of 2008, caused by the greed of powerful banks and their executives. At the end of the day, the government had no choice but to help these institutions back to their feet to bring stability to the collapsing market, even though they were responsible for the crisis in the first place, leaving the ordinary man to pick up the pieces. Cryptocurrency represents a new world order. Cryptocurrency is the way ordinary people can take back financial control and direct it according to the majority's will and not the elite few. Bitcoin was able to take advantage of the internet and advancement in cryptographic knowledge to create a virtual currency that promises everything lacking with our everyday fiat currency. The first proposed benefit of cryptocurrencies is decentralization, a financial system that cannot be controlled by a few. For example, Bitcoin is created through the process called mining that requires a crowd of people to function, unlike the US dollar, which is printed by a single authority. Cryptocurrencies also promise faster and cheaper payments, cross-border transactions, and better financial privacy and security, among others. In practice, however, cryptocurrencies have not been able to replace fiat currencies, and it might be very difficult for Bitcoin to ever function properly as an everyday currency. However, the invention of Bitcoin opened the path to an industry where different cryptocurrencies have risen to improve over their shortcomings, and even take their underlying blockchain technology to a new level. Ethereum was also built on the successes of Bitcoin, adding smart contracts to channel the power of blockchains to the creation of decentralized applications. Frankly, cryptocurrency neglects all the rules of a good investment. The entire industry is unregulated. The currencies rarely have an underlying, and often the founders of these currencies are anonymous and unaccountable. Nevertheless, people's belief in the power of decentralized finance is the one thing that's driving the industry. So yes, cryptocurrency remains a high-risk investment, but the potential upside is huge. Let's forget about its future for a minute. The crypto industry has already come a long way since Bitcoin's white paper was launched in 2008. The industry has accumulated a value worth $2 trillion in just over a decade. Now let's bring the future back into the fold. The crypto market is in high demand, with supporters just waiting for the various cryptocurrencies to become more sustainable. If the industry reaches its potential, the returns will dwarf the current market cap of $2 trillion. But of course, such a future will punish skeptics severely, while the investors smile at the bank. Since no investment is guaranteed to provide returns, investing in cryptocurrency is an excellent way to diversify your portfolio and hedge against the market. Not to mention the fact that cryptocurrencies have a practical utility. That is, you can spend your Bitcoin to pay for stuff. In addition, holding many other cryptocurrencies gives you benefits like governance of the project, access to financial services, etc. In short, the potential returns on investing in cryptocurrency are well worth the risk, as long as you apply good judgment. Also, unlike traditional investments like stocks and bonds, there are several different ways you can apply your capital to make a profit in the crypto industry. For example, rather than just leaving your crypto assets to increase in value, you can put them to work. How? Well, you can participate in yield farming, staking, liquidity mining, and other DeFi activities to earn regular passive income with your crypto assets. The cryptocurrency market is slippery, and you will fall if you don't take careful steps. You should have a few things at the back of your mind before making your investments. Number 1, the cryptocurrency market is volatile. Things move fast in the crypto world, and the smallest things cause significant waves. Do you know any other industry where a single tweet can crash the market? Unfortunately, that's the kind of volatility you must contend with when investing in cryptocurrency. Therefore, it pays to take it a step at a time and build your portfolio of cryptocurrencies over time. The saying "fools rush in" could never be more accurate. Number 2, research before anything. Research is a staple of investment, but given the crypto market's volatility and lack of regulation, investors have to take extra care. Many cryptocurrency projects fill their white papers with shiny features and logical solutions. Still, very few of these can live up to their promises, leaving investors in the dump. Frightening, isn't it? That's why you hear "do your own research" every corner you turn. Some projects are outright scams, designed just to trick investors and make away with a big paycheck. On the other hand, you have meme coins, which are upfront about their lack of intrinsic value, but still bring mind-blowing returns. Ideally, you should start small and get a feel for how the market works. Then, involve yourself actively in the market with money you can afford to lose, and you might pick up a trick or two and develop a sixth sense. Number 3, timing is everything. To capitalize on a volatile market, you must be tactical about timing. However, savvy investors with diversified portfolios treat crypto as what it is, a speculative market. While the industry is new, it already moves in patterns. For example, changes in the value of Bitcoin directly cause changes in the value of the entire market in the same direction. Number 4, taxes. It is easy to get lost in the ideal of centralization and forget that the government still runs things, so you still have to pay taxes on your crypto gains. In the United States, for instance, cryptocurrency is not treated like regular currency, and it is taxed like a regular investment. Like other investments, crypto assets are only taxed when you move to sell them. The US also taxes you on mined tokens, rewards from yield farming, and other DeFi activities. Number 5, don't forget your wallet keys. Crypto assets are very delicate. Remember, they exist only in the virtual world, in virtual wallets, secured only by private keys. These keys, usually alphanumeric digits, are generally impossible to retrieve. If you ever forget or lose your wallet key, you can say goodbye to whatever cryptocurrencies you had stored in it. Crypto wallets are also subject to cyber attacks and hacks. Cold wallets are the best way to protect your digital assets from online attacks, especially if you have suspicions. Cold wallets are physical storage devices that store your crypto assets offline, like hard drives, flash drives, and SSDs. However, most people choose secure online wallets because they're more accessible. Therefore, selecting a trusted and secure wallet is one of the first steps to investing in cryptocurrency. Bitcoin, the first and most popular cryptocurrency, has the highest market cap, hovering at about $500 billion in 2022. But Bitcoin also offers the least potential returns. So why limit yourself when there are plenty of promising cryptocurrency projects with smaller entry costs and much higher potential returns? Still, as a newcomer, it's wise to take it slow. Well-established cryptocurrencies with a significant room to grow are good places to start. For example, cryptocurrency projects with stable market caps like Cardano, Litecoin, XRP, Solana, BNP, Tron, Avalanche, and Polygon are reasonable starting points. Another strategy for beginners is to go after penny cryptocurrencies. Penny cryptocurrencies are cryptos that trade for less than $1 per coin. Choosing penny cryptos involves deep research into the underlying project, financial performance, and community support. XRP, for example, trades for less than $1, enjoys plenty of community backing, and is one of the first major cryptocurrencies on the scene. And while the project is tied up in a lawsuit, it still sits in the top 15 cryptocurrencies by market cap. If the court case ends up positively, XRP could see a massive boost in value. Another example of promising penny crypto is the DeFi coin, the creation of a trusted and well-established team with nearly 35 years of crypto experience. The underlying project, a DeFi exchange, is gaining massive market share, while the coin currently trades under $1. All in all, you will need to study the crypto market and stay ahead of the happenings to find and take an early stake in promising crypto projects. No doubt, you must have heard the word crypto trading used as a synonym for crypto investment. Enthusiastic crypto fans throw the word around, sharing the latest strategies and tactics to beat the market. However, trading cryptocurrencies is different from investing. So if they're not the same thing, what are the differences? Well, first of all, the time scope between the two is different. Crypto traders work within a short time frame. They are constantly moving their funds from one coin to another, making a profit over the daily ebb and flow of the market. They usually don't care about the underlying value of the coins they buy and sell. Crypto traders rarely hold a position for more than a few days. Crypto investment takes the longer route, using long-term strategies that require insight into the underlying project of the cryptocurrencies. In crypto parlance, these are called hodlers. Holding cryptocurrency for a long time in an industry notorious for its volatility requires active research. On the other hand, trading requires continuous effort and daily input to stay on top of the market. Therefore, crypto trading can quickly turn into a full-time job. Fortunately, the world of cryptocurrency is very hands-on. There is no need for a broker or any such thing. You only need a few things to get started as a cryptocurrency investor. Number 1. Open a crypto wallet. You can choose from several different types of wallets, but they don't all support the same types of cryptocurrencies. Therefore, you should select and open a crypto wallet that supports the coins you are interested in. Number 2. Register with a crypto exchange. Crypto exchanges are the center of all crypto activities. They help you change fiat money into the crypto asset of your choice. Some of the most reliable crypto exchanges are Binance, Crypto.com, eToro, Kraken, and Coinbase. Number 3. Fund your account. You will need to deposit funds with your exchange to buy your chosen cryptocurrencies. Then you can transfer the coins you purchase from your wallet across different wallets. And that is all we have for you today. Don't forget to like this video if you've learned a thing or two, and click the subscribe button to stay updated on the happenings of the cryptocurrency market.